Disclaimer.
It's me, your servant AG. You know, I'm having trouble sticking exactly to the market since I'm posting my video before it closes. There may be slight variations, but what I'm about to reveal will interest you. If you're watching the charts today, you think you're seeing a crash. But you aren't. What happened between 9 a.m. and 1 p.m. today, January 27th, 2026, wasn't a market correction. It was a coordinated execution. While silver was reclaiming $117, the CME group pulled the kill switch, jacking up margins by 47% in a desperate attempt to protect banks that are currently bleeding billions. But the banks aren't the only ones in trouble. For the first time in American history, a sitting Fed chair is facing a DOJ criminal investigation. As the U.S. dollar index slides toward 96.96, Jerome Powell isn't just fighting inflation, he's fighting for his freedom. This is the Sell America trade in real time, and silver is the only exit door left. The mainstream media wants you to focus on the $103 dip. They don't want you to see that physical silver in Shanghai is still trading at $125. They don't want you to know about the 44 firms that just went insolvent in India because they bet against this rally. Today, we aren't just looking at a price tag. We are looking at the final divorce between the paper lie and the physical truth. Silver collapsed from $117.73 down to $103.89 in just 4 hours. $15 vanished faster than most Americans finished their morning coffee. The Chicago Mercantile Exchange forced traders to either post massive additional collateral or liquidate their positions immediately. Predictable chaos followed as billions in paper silver contracts got dumped onto the market like sandbags during a flood. But here's where the story gets interesting. By noon, silver had already clawed its way back to $110.60. The biggest margin hike in CME history, designed specifically to crush the rally, and the price rebounds $7 within hours. That's not how crashes work. Real crashes don't bounce back before lunch. The paper traders got shaken out exactly as planned, but physical buyers immediately stepped in to scoop up metal at discount prices. While retail investors were panicking and selling, institutions were quietly acquiring tons of actual physical metal. Let me put this in perspective for you. Imagine the Federal Reserve announced they were doubling interest rates overnight to kill a housing bubble. Prices dropped 30% by breakfast, exactly as intended. But then by lunch, housing prices have already recovered 20% because buyers are lined up around the block with cash in hand, refusing to let homes stay cheap. That would tell you something fundamental about housing demand, wouldn't it? It would tell you that no matter what the central bank does, real buyers want those houses more than the Fed wants to stop them. That's exactly what we're seeing in silver right now. The establishment threw everything they had at this rally, the single largest margin increase in exchange history, and the market absorbed it in 4 hours. Our dollar, our financial system, our precious metals markets are all converging toward a moment that arrives this Wednesday afternoon at 2:30 p.m. Eastern Time. The U.S. dollar index is dancing dangerously close to 97.00. Global currency traders are watching not just monetary policy, but whether Powell still has the authority to set it. The dollar is hanging by a thread because foreign holders of our currency are asking themselves a very simple question. If the Fed chair might be removed or indicted, why should we trust the dollar he's defending? Think about this scenario. You're a Japanese pension fund holding $200 billion in U.S. treasuries. You turn on the news and see the Fed chair under criminal investigation. Do you hold those bonds or do you start quietly selling? You're a Middle Eastern sovereign wealth fund with $300 billion in dollar reserves. Do you wait to see how this plays out? Or do you diversify into euros, yen, and precious metals while you still can? This is the hidden connection between tomorrow's Fed meeting and this morning's silver crash. The margin hike wasn't random timing. It was a coordinated move to suppress precious metals prices right before the most consequential Fed meeting in our lifetimes. Someone very powerful needed silver and gold to look weak heading into Wednesday's announcement. They needed the narrative to be that everything is fine, the metals rally was just speculation, and the dollar remains strong. But here's the problem with that narrative. The rebound to $110.60 completely destroyed it before the opening bell even rang. The paper market said silver should crash. The physical market said, we're buying every ounce you're willing to sell at these prices. And physical always wins eventually because you can't pay for real goods and services with paper promises. Pop quiz, what happens when an unstoppable force meets an immovable object? We're about to find out. The unstoppable force is global demand for physical silver, driven by industrial needs, investment demand, and currency concerns. The immovable object is the Western financial establishment that needs precious metals prices contained to maintain confidence in fiat currencies. This morning's crash was the establishment's best shot. They fired their biggest weapon, and the market barely flinched. Now here's where this gets personal for every American, with savings, investments, or retirement accounts. If 97 support breaks on the dollar index, we're not talking about a gradual decline. We're talking about a gap down that could take the dollar to 92 or lower before anyone has time to react. In currency markets, that kind of move triggers automatic selling programs, margin calls, and panic liquidations that feed on themselves. What does that mean for silver? If the dollar gaps down on Wednesday afternoon, silver doesn't gradually climb to 120 or 130. It gaps up. Futures traders wake up Thursday morning to find silver already at 135, 140, maybe higher, with no way to enter positions at reasonable prices. The people holding physical metal right now will have already captured that move. Everyone else will be chasing. The establishment knows this. That's why they pulled out the 47% margin hike this morning. That's why they coordinated the selling, to create maximum panic. They need shorts to stay short and longs to give up before Wednesday's announcement. They need retail investors to believe the crash narrative so badly that they don't notice what's actually happening in the physical market. But physical demand is now officially overriding paper market manipulation. That sentence should be tattooed on every precious metals investor's forehead. For decades, paper contracts controlled price discovery in silver. If big banks wanted silver at $20, they printed enough paper contracts to create artificial supply until the price hit $20. The physical market followed along like a puppy on a leash. That relationship just broke. This morning proved it. Physical buyers looked at the paper crash and said, "We don't care what your margin requirements are. We don't care what your technical charts say. We don't care about your narrative. We want metal, and we want it now." That's a seismic shift in how precious metals markets function. It means the next move up won't be controlled or gradual. It will be violent and sudden because the paper market has lost its ability to govern price. Have you noticed that every major financial crisis in our history was preceded by authorities insisting everything was fine? 2007 housing market, all healthy. 2008 financial system, strongest banks in the world. 2020 pandemic response, totally under control. And now, 2026 dollar stability, nothing to see here. The pattern is so consistent, it's almost funny, except it's our savings on the line. Wednesday afternoon at 2:30 p.m. Eastern, Powell steps to that podium knowing the world is watching not just for interest rate guidance, but for signs of weakness, indecision, or vulnerability. If he stumbles, if his authority appears diminished, if the criminal probe shadows his credibility, currency traders will pounce. They won't wait for official announcements or policy clarifications. They'll sell first and ask questions later. And when they sell dollars, they buy something else. Gold, silver, euros, Bitcoin, it doesn't matter. They just need to be out of dollars before everyone else has the same idea. That's how currency crises work. They don't unfold over months or years. They happen in hours or days once confidence breaks. Our country, our currency, our financial stability, all hinge on whether Powell can project strength at the exact moment when his position has never been weaker. The $15 crash this morning was the Fed's way of saying we still control this market. The $7 rebound by lunch was the physical market's way of saying, no, you really don't. And tomorrow we find out which force is stronger. The paper manipulation machine that's worked for decades, or the physical reality that's finally saying, enough. 110.60 isn't a victory for silver bulls or a defeat for shorts. It's a warning shot. It's the market telling us that the old playbook doesn't work anymore, that the tools central banks relied on to manage perception are losing their power. And that what comes next won't follow historical patterns because we're in uncharted territory. The real danger doesn't start with this morning's crash. The real danger starts Wednesday afternoon when our financial establishment has to choose between defending the dollar and defending Fed independence. They can't do both. And whatever choice they make, the consequences will echo through precious metals markets, currency markets, and every American's financial future for years to come. The mechanical trap is set. The margin hike forced weak hands out. The rebound confirmed strong hands are ready to buy any dip. And Wednesday's deadline is approaching fast. This isn't about predicting the future. This is about recognizing the present for what it really is, a powder keg with the fuse already lit and everyone pretending they don't smell smoke. While American traders were watching numbers flash red on their screens this morning, something catastrophic was unfolding 7,000 miles away in Rajkot, India. 44 trading firms just declared insolvency. Not bankruptcy proceedings, not restructuring talks, insolvency. The kind where you turn off the lights, lock the doors, and tell your clients their money is gone. These weren't small-time operations gambling with lunch money. We are talking about established commodity trading houses that collectively lost $425 million in a single morning. They made the same bet the big Western banks made, that silver would crash and stay crashed after the margin hike. They were wrong, and now their entire businesses have ceased to exist. Think about what has to happen for a trading firm to go from operational to insolvent in 4 hours. You don't just lose money. You lose so much money so fast that there's no recovery possible, no bailout big enough, no asset you can sell to cover the losses. The Rajkot firms were leveraged to the maximum on short positions. betting against silver's rise with borrowed money. When the CME raised margins by 47%, they had to post collateral they didn't have. When they couldn't post, their positions got liquidated at the worst possible prices. But here's the part that should terrify anyone still holding paper silver shorts. Those 44 firms didn't cause the morning crash. They were victims of it. The crash was engineered by the CME to protect much larger players, the multinational banks with billions in short exposure. The Rajkut traders were just collateral damage, acceptable losses in a desperate attempt to shake out the rally before it destroyed the entire paper-silver market. The math is brutally simple. If you're short silver at $80 and it goes to $120, you're down $40 per ounce. If you're short 10 million ounces, that's $400 million in losses. Now multiply that across every major bank and institution that's been suppressing silver prices for decades. We're not talking about millions anymore. We're talking about billions, potentially tens of billions in unrealized losses that become very realized very quickly if prices keep climbing. That's why the CME pulled the kill switch this morning. That's why they implemented the largest margin hike in their history. They weren't trying to stabilize markets or ensure orderly trading. They were trying to save banks that made catastrophically bad bets and can't afford to lose. Now let's talk about the Shanghai Gold Exchange, because this is where the divorce between paper and physical becomes undeniable. While Comex silver was crashing to $103 this morning, physical silver in Shanghai maintained an 11% premium. 11%. The same metal, the same day, the same hour, trading at fundamentally different prices on opposite sides of the world. In a functioning global market, that arbitrage opportunity disappears in minutes. Traders buy the cheap silver in New York, sell the expensive silver in Shanghai, pocket the difference, and the prices converge. Except that's not happening. The premium persists because you can't actually get physical silver from Comex to Shanghai fast enough to capture that spread. More importantly, Chinese buyers don't trust Western paper silver at any price. They want metal they can touch, weigh, and vault in their own country. According to the Shanghai Gold Exchange data, physical silver premiums have been climbing steadily since December 2025. What started as a 2 to 3% premium has expanded to double digits. This tells us that Chinese industrial buyers, investors, and institutions have collectively decided that Western price discovery is no longer reliable. They are willing to pay significantly more for guaranteed physical delivery rather than gamble on paper contracts that might settle in cash. This is the grand divorce playing out in real time. For decades, Comex prices led and physical markets followed. If New York said silver was $25, Shanghai eventually agreed. That relationship has broken down completely. Physical markets are now setting their own prices based on actual supply and demand, while paper markets are setting prices based on margin requirements, short covering, and institutional desperation. The Bank for International Settlements, the central bank for central banks, reported in their latest quarterly review that physical precious metals deliveries have reached record levels, while paper contract open interest has declined. Translation: big money wants real metal, not promises. They're exiting paper positions and demanding physical delivery at a pace that's straining the entire global supply chain. Let me show you what that strain looks like in hard numbers. Comex registered silver stocks, the metal that's actually available for delivery against futures contracts, have plummeted to 127 million ounces. That sounds like a lot until you realize it represents less than 3 months of global industrial demand. In the past week alone, 33.45 million ounces were withdrawn from Comex vaults. That's a 26% drain in 7 days. Think about what happens when those vaults approach empty. Every futures contract holder who actually wants silver instead of a cash settlement suddenly realizes they are in a musical chairs game where there aren't enough chairs. The scramble for physical delivery could force Comex to declare force majeure, essentially admitting they sold more silver than they actually have. That scenario, once dismissed as conspiracy theory, is now being discussed openly by metals analysts as a realistic possibility within months. The World Gold Council published data last week showing that central bank gold purchases reached record levels in 2025, with emerging market central banks leading the buying. While they don't report silver purchases with the same transparency, industry sources indicate that sovereign nations are accumulating silver alongside gold at ratios not seen since the 1970s. Countries that depend on US dollar reserves are quietly diversifying into hard assets that can't be frozen, sanctioned, or inflated away. This is happening because trust in the dollar system is evaporating. When the Fed chair faces criminal investigation, when the dollar index breaks support levels, when political interference in monetary policy becomes overt rather than covert, foreign central banks don't wait for official confirmation that something is wrong. They act preemptively to protect their national interests. Have you noticed that every major geopolitical shift in the past year has been accompanied by metal accumulation? Russia restricted palladium exports. China limited rare earth metals. Now China has imposed strict controls on silver exports, citing domestic industrial needs. These aren't coincidental policy decisions. Their coordinated moves to secure strategic resources before a global supply crisis becomes obvious to everyone. The Chinese export wall for silver is particularly significant because China produces roughly 30% of global mined silver. When they restrict exports, they're not just reducing supply to international markets. They're sending a signal that they believe silver will be worth substantially more in the near future, and they want to keep it in their country. Nations don't restrict exports of commodities they think are going to decline in value. According to the U.S. Geological Survey, global silver mine production has been essentially flat for 5 years, while industrial demand, particularly for solar panels and electric vehicle components, has increased by 40%. The deficit is being met by drawing down above-ground inventories, recycling, and selling investment holdings. Those sources are finite and dwindling rapidly. Here's what this means in practical terms. Every solar panel requires roughly 20 grams of silver. Global solar installations are projected to double by 2030. Electric vehicles use roughly twice as much silver as conventional cars. EV sales are accelerating globally. 5G infrastructure requires significantly more silver than 4G. The rollout continues worldwide. These aren't speculative future demands. These are contracts already signed, projects already funded, factories already built. The industrial silver deficit, the gap between what's mined and what's consumed, was estimated at roughly 200 million ounces last year. That gap is widening because you can't just decide to mine more silver. New mines take 5 to 10 years to develop. Existing mines are depleting their highest grade ore bodies, and silver is primarily a byproduct of other metal mining. So increasing silver production means increasing copper, lead, and zinc mining, which has its own supply constraints. While this structural deficit was building, the paper-silver market kept prices artificially suppressed through an unlimited supply of contracts. Banks could print futures contracts faster than miners could pull metal from the ground, and those paper contracts controlled price discovery. That system worked as long as contract holders were willing to accept cash settlement. It stops working the moment they demand physical delivery. The Rajkot insolvency is the first domino. Those trading firms thought they were making a smart bet against an over-leveraged rally. They didn't realize they were betting against a fundamental supply-demand imbalance that has been building for years and is now reaching a breaking point. The Shanghai premium is the second domino, proving that physical buyers no longer trust Western price discovery. The Comex vault drainage is the third domino, showing that big money is demanding metal regardless of what paper prices suggest. Wednesday's Federal Reserve meeting is the catalyst that could topple all remaining dominoes simultaneously. If Powell's authority is openly questioned, if the dollar breaks 97 support, if foreign central banks accelerate their diversification out of dollars, the remaining holders of paper silver shorts will face a choice. Cover your positions at any price or risk unlimited losses, as physical silver gaps higher with no available supply to deliver against your contracts. The Rajkot traders learned this lesson the hard way. They're not coming back from 425 million in losses. The big Western banks haven't learned it yet because they still believe the system will protect them. They think the Fed will intervene, the CME will change the rules again, the government will step in to prevent their failure. They're counting on bailouts that might not come when the entire dollar system is under stress. This morning's crash wasn't the end of the silver rally. It was the final warning shot before the real move begins. The weak hands got shaken out. The strong hands accumulated more metal. And the institutions that needed silver to stay suppressed just burned their biggest ammunition trying to create a crash that couldn't hold for even 4 hours. What comes next isn't a question of if, but when. And Wednesday afternoon at 2:30 p.m. Eastern Time is rapidly becoming the most likely answer. Let's talk about math, because numbers don't lie even when markets do. Gold is currently holding steady at $5,100 per ounce. Silver closed today at $110.60. That gives us a gold to silver ratio of roughly 46 to 1. Now here's what every precious metals analyst knows, but few are willing to say out loud. That ratio is historically, fundamentally, and mathematically unsustainable. The historical mean for the gold to silver ratio over the past century is approximately 40 to 1. During periods of monetary stress, financial crisis, or currency instability, that ratio compresses even further as silver catches up to gold's moves with violent momentum. In 1980, the ratio briefly touched 15 to 1. In 2011, during the European debt crisis, it reached 32 to 1. We are currently at 46 to 1, with arguably the most severe dollar crisis in American history unfolding in real time. Do the math with me. If gold holds at $5,100 and the ratio compresses to the historical mean of 40 to 1, silver needs to trade at $127.50. That's not speculation. That's not hopium from silver bugs. That's basic arithmetic applied to century-long historical patterns. The current price of $110.60 represents a fundamental discount to where silver should be trading if normal market relationships still applied. But normal market relationships stopped applying somewhere around the time the Fed chair got criminally investigated and the dollar index started breaking critical support levels. We're not in a normal market environment. We're in a regime change moment where old rules get rewritten and historical patterns either reassert themselves violently or get replaced by something entirely new. Here's what should keep silver shorts awake tonight. If the ratio compresses beyond the historical mean, if we get panic buying instead of orderly reversion, if physical supply constraints force prices higher, regardless of what paper markets suggest, we're not looking at 127.50 as the target. We're looking at 140, 150, potentially higher, depending on how fast confidence in the dollar deteriorates. Think about the sequence of events that could trigger that kind of move. Tomorrow, January 28th, Jerome Powell walks into the Federal Open Market Committee meeting at 2 p.m. Eastern. The world is watching. Currency traders have their fingers on the sell button. Gold and silver are coiled like springs after this morning's forced liquidation. The DXY is teetering at 97 support with nothing but air underneath if it breaks. Powell has to project strength, authority, and confidence in the dollar at the exact moment when his personal authority has never been more questioned. He has to convince foreign central banks that U.S. monetary policy remains independent and credible despite criminal investigations and political pressure. He has to do all this while knowing that every word he says will be analyzed for weakness, hesitation, or vulnerability. What happens if he stumbles? What happens if a reporter asks about the DOJ investigation and he gives an unsatisfying answer? What happens if his prepared statement sounds defensive rather than authoritative? Currency markets don't wait for clarification or follow-up statements. They react in milliseconds to perceived weakness, and once the selling starts, it feeds on itself. If DXY breaks 97 and gaps down to 95 or 92, precious metals don't gradually climb higher over days or weeks. They gap up overnight. Futures markets open Thursday morning with silver already at 135 or 140, and retail investors who were waiting for confirmation suddenly find themselves chasing a rally they can't catch at reasonable prices. This is the independence trap. The Federal Reserve's credibility depends on being independent from political interference, but that independence is now being openly challenged by criminal investigations that suggest Fed leadership broke laws or violated public trust. Powell can't defend Fed independence without addressing the investigation, but addressing the investigation acknowledges that independence is under threat. It's a no-win scenario for him personally and potentially catastrophic for the dollar if markets interpret his response as weakness. Pop quiz: what do foreign central banks do when they lose confidence in Fed leadership? They diversify out of dollar reserves. What do they buy when diversifying? Gold, silver, euros, yuan, anything except the asset they're losing faith in. And when multiple central banks start selling dollars simultaneously, the moves aren't gradual. They're gap events that happen faster than anyone can react. The White House knows this. That's why there's speculation about replacing Powell mid-session if tomorrow's meeting goes poorly. But replacing a Fed chair during an FOMC meeting would be an unprecedented violation of Fed independence that would accelerate the very dollar crisis they're trying to prevent. It's another no-win scenario where both action and inaction carry catastrophic risks. Here's what this means for anyone holding physical silver or considering buying right now. You're not speculating on a rally. You're holding insurance against the most consequential monetary policy moment in our lifetimes. If Powell successfully navigates tomorrow's meeting and the dollar holds support, silver probably consolidates around 110 to 115 for a few days before resuming its climb toward 127.50, based purely on gold to silver ratio reversion. But if Powell fails to project confidence, if the dollar breaks support, if foreign selling accelerates, you're looking at a gap move to 135 or higher before most people realize what's happening. The difference between those two scenarios is whether you position before Wednesday or try to chase afterward. Let me be crystal clear about what happened this morning and why it matters. The CME implemented a 47% margin hike, the largest in their history, specifically designed to crush the silver rally and protect institutional shorts. Billions of dollars in paper contracts got liquidated. The price crashed $15 in 4 hours. Every technical indicator screamed sell. Every mainstream analyst called it the top. And by lunchtime, the price had already recovered $7 because physical buyers said, "We don't care about your margin requirements, we want metal." That 4-hour sequence proved conclusively that physical demand has overridden paper market manipulation. The tools that worked for decades to suppress precious metals, prices no longer function when actual buyers want actual metal regardless of what futures contracts suggest. This morning was the Fed's last paper bullet, and it couldn't even maintain a crash for half a day. What happens when the next wave of buying hits and there are no paper bullets left? What happens when Comex registered inventories drop below 100 million ounces and contract holders start demanding delivery in numbers that can't be satisfied? What happens when the Shanghai premium widens to 15 or 20%? Because Chinese buyers conclude Western markets are completely disconnected from physical reality. These aren't hypothetical questions. These are scenarios with actual probability based on inventory data, demand trends, and market dynamics that are observable right now. The Rajkot insolvency already proved that leveraged shorts are getting destroyed even during engineered crashes. The Shanghai premium already proved that physical buyers are willing to pay significantly more than paper prices. The vault drainage already proved that big money is extracting metal from the system at unprecedented rates. Wednesday's Fed meeting is the catalyst that determines whether these trends accelerate suddenly or continue building pressure gradually. Either outcome eventually leads to significantly higher silver prices, but the path and timing depend entirely on what happens when Powell steps to that podium at 2:30 p.m. Have you positioned yourself accordingly? Have you calculated your exposure to dollar weakness, your allocation to hard assets, your strategy if silver gaps higher overnight? Or are you waiting for more confirmation, more data, more certainty before making decisions that should have been made weeks ago? The $15 crash this morning was designed to make you doubt the rally, question your analysis, and wait for better entry points. It was psychological warfare masquerading as market action. The $7 rebound by lunch was the market's way of saying the fundamentals haven't changed. The supply deficit is real, and the disconnect between paper and physical is widening regardless of what the CME does with margin requirements. This isn't about predicting the future or timing the perfect entry. This is about recognizing that the system is breaking down in real time, and positioning before the break becomes obvious to everyone. Once DXY breaks 97, once Powell's authority is openly questioned at tomorrow's presser, once foreign central banks accelerate their dollar diversification, the opportunity to position at current prices vanishes. Silver at 110.60 with gold at 5,100 represents a 46-to-1 ratio that historically reverts to 40-to-1 or lower during monetary stress. The math says 127.50 minimum. The industrial deficit says supply can't meet demand. The Comex inventories say the physical metal to deliver against contracts is running out. The Shanghai premium says Eastern buyers have already priced in significantly higher values. And Wednesday's Fed meeting says the catalyst for violent repricing might arrive in less than 24 hours. The final warning isn't coming from me. It's coming from the market itself. 44 insolvent trading firms in Rajkot, 11% physical premiums in Shanghai, 33 million ounces withdrawn from Comex in a single week. A 47% margin hike that couldn't hold prices down for 4 hours. These are flashing red signals that the paper system is failing and physical reality is taking over. If you're not holding physical metal or zero leverage positions before 2:30 p.m. tomorrow, you're gambling that Powell successfully navigates the impossible, that the dollar holds support despite criminal investigations, that foreign central banks maintain confidence despite every reason not to, and that the most over-leveraged short squeeze in precious metals history somehow does not materialize when every indicator says it should. That's not a gamble I'm willing to take. That's not a risk profile that makes sense when the alternative is holding an asset that's been money for 5,000 years and is currently trading at a fundamental discount to where historical ratios say it should be. The choice isn't whether to buy silver. The choice is whether to position before Wednesday or chase the rally afterward at prices that might be 20 or 30% higher. The crash you saw this morning was the establishment's last desperate attempt to shake you out, take your metal at discount prices, and convince you the rally is over. The rebound you saw by lunch was reality reasserting itself despite their best efforts to suppress it. And tomorrow afternoon, we find out whether the dollar system can survive the most consequential Fed meeting in American history, or whether the final divorce between paper promises and physical truth accelerates into a full-blown crisis. The math doesn't lie. The inventories don't lie. The premiums don't lie. The only question is whether you're positioned for what comes next, or whether you'll be watching from the sidelines as silver gaps to 135, 140, or higher, while you're still trying to decide if the rally is real. That $15 crash this morning was your last chance to buy the dip. By Wednesday evening, we'll know if it was also your last chance to buy below 120.